Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at mobile health network solutions.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Yeah, let's do it. This company, Mobile Health Network Solutions, has a fascinating story right now.
It really does. It's a story of extreme transformation. We're watching a company go through a pivot that is, well, it's incredibly rapid and decisive.
Right. They didn't just tweak their model. This feels more like they performed major surgery on the business.
That's a perfect way to put it. The main thing to grasp from this last year is they've fundamentally shifted away from being, tied down by these heavy physical clinical operations.
Okay, so what did they shift to?
That's the whole narrative. It's a radical move to an entirely asset-light, AI-driven virtual care platform.
And that context is key, I imagine, when you look at the financials.
It's everything. You have to hold that in your mind when you look at their full fiscal year 2025 results.
Because on the surface, those numbers, they could scare some people away.
Oh, absolutely. The casual observer will see revenue at $7.7 million, which is a big drop, a 45.3% decline year on year.
Wow.
But that drop is the painful part. It's the reality of them shedding those legacy revenue-generating clinics.
It's the cost of doing business, so to speak, the cost of the transition.
Exactly. But here's the paradox that the market seems to be rewarding. By cutting that top-line revenue, they slashed far, far more in painful costs. This strategic move, it led to really substantial immediate cost optimizations.
So the bottom line tells a different story.
A completely different story. The difference is night and day. Their net loss narrowed dramatically. I mean, we are talking about taking a loss of $15.6 million in FY 2024.
A huge number.
All the way down to just $3.4 million in FY 2025.
That's incredible. That's the core of the bull thesis then, isn't it?
It really is. That massive leap in operational efficiency, cutting the burn rate by over $12 million, it shows management is prioritizing their runway and a path to profitability over just hanging on to old market share.
It proves the new lean model can actually work.
Precisely.
Okay, so they've shown they can operate leanly, but what about the financial foundation? I mean, a shift this big still needs capital, right? Even if it is virtual.
That's where that term asset light really comes in. It's a game changer because their whole operational model now requires far less fixed cost, less upfront capital than all their traditional competitors.
That's scalability 101 in modern tech.
It is.
Now, for listeners who aren't, deep in the weeds of microcap finance, we see these terms like a $300 million ATM facility and a $10 million SEPA commitment. Can you break down what that actually signals about how they're funding all this?
Yeah, that's a great question. An ATM, or at-the-market facility, it basically gives the company the flexibility to sell registered stock directly into the market over time.
So not one big dilutive capital raise all at once.
Exactly. They can sort of drip-feed shares to raise funds just as they need them. It gives them that capital flexibility without any major shocks to the stock price. It's tactical.
Opportunistic fundraising. Makes sense.
And the SEPA, the Standby Equity Purchase Agreement, it provides a similar layer of security. It means they have a committed investor who's agreed to buy shares up to a certain amount whenever the company decides it needs the cash.
So safety nets.
Right. Both of these instruments, they underscore a really disciplined approach to capital. They're making sure their balance sheet is flexible while keeping debt levels really low compared to others in their sector. That's hugely reassuring during a high-growth pivot like this.
Okay, so the finances look prudent, efficient, but the real growth engine here has to be the technology itself. You can't just say you're a virtual care company without some serious tech to back it up.
Absolutely not. And technological leadership is, without a doubt, the central pillar of their new strategy. And you can see it's tangible, starting with their own proprietary AI tool, 5GPT.
Right, they call it an AI-powered health companion. It's good marketing, but the fact that they're building their own solution, this 5GPT, that suggests they want to control the user experience.
Control the experience and, crucially, the data flow. They aren't just relying on some third-party generative AI model.
Which is key for compliance in healthcare.
It is. But the commitment goes way beyond just a single piece of software. I mean, you have to look at the infrastructure move they made back in September.
This must be where that capital from the ATM might be going, the deal for the data centers in Malaysia.
That's the one. They signed an MOU to acquire 2 AI-optimized data centers.
Yep.
The price tag is up to $120 million.
And what's clever here is the payment structure, isn't it?
It's very clever. They're paying for the bulk of it in Class A ordinary shares.
Ah, so they preserve their cash.
Exactly. They keep their cash reserves for execution, for scaling the platform, while still getting the muscle they need for massive data processing. This isn't just about servers. It's about owning the global computing foundation of their entire digital health network.
That gives them a pretty significant competitive edge. I mean, they're building a proprietary network from the ground up, designed for their specific needs. They're sidestepping the heavy local competition that the legacy clinics are stuck in.
And by being platform first, they can use any of those old brand relationships they built to now cross-sell their new, higher-margin virtual services. They already have a foot in the door.
Yeah, they're just selling a much better product.
A Ferrari engine instead of a bicycle, yeah.
And we are seeing that play out internationally already. The expansion isn't an afterthought. It seems to be a core driver of their future revenue.
It's central to the whole thesis. You see this dual momentum happening across 2 huge markets. First, they're beefing up their presence in Asia, expanding their digital doctor network in Indonesia.
Which is a massive and rapidly growing healthcare market.
Huge potential for digital adoption there.
Yeah.
But I think the most intriguing move is their entry into Africa.
Yeah, tell us about that.
They initiated their first African partnership by going into Ghana's developing healthcare market.
Yeah.
Now think about the advantage of an asset-light model in a place like Ghana.
Where traditional infrastructure might be lacking or spread out.
Exactly. An AI-powered virtual care service, it can instantly bridge those geographical gaps and resource limitations. They aren't fighting legacy systems there.
They're filling a critical, unmet need.
They really are. And it positions mobile health network solutions as a truly global, asset-light digital healthcare platform. The combination of that Asian scale, the new African initiative, and that core cost restructuring is what makes this a compelling story.
High scale, low fixed costs, and massive market potential. Okay, that makes the thesis really clear. Let's pivot now to the immediate future. For investors watching this, what are the hard, short-term drivers we should be watching over the next 3 months?
Okay, so the calendar is actually pretty dense with activity.
First up is mid-December. We have the Q1 2026 earnings release. This feels essential.
It is. This is the first big test. Q1 will be the confirmation that the asset-light model is actually translating all these global partnerships into real, sustained operational improvement.
And then right after that, late December, there's a holiday telehealth utilization report.
Yeah, and that's an interesting one. Telehealth usage naturally spikes during the holidays when people are traveling or can't get to a clinic. So this report will give us a really crucial early read on adoption rates during a peak demand period.
Then we roll into January. There's always some potential volatility with ETF rebalancing, but what's the real signal to watch for?
The signal that matters is reported institutional buys mid-month. If we see big institutions stepping in, it suggests the smart money is buying into this turnaround story.
And then the next huge marker is mid-February, Q3 earnings.
That might be the most pivotal date of all. Q3 should show the first real financial impact from integrating those Malaysian data centers and from the expanded African initiatives.
So beyond the dates on the calendar, there's always the market speculation, the rumors that can drive a stock. What's the chatter around this one?
The chatter is very active. The most impactful rumor, I think, involves a potential major U.S. hospital network integration.
Wow, that would be huge.
It would be. The speculation is that this hospital network would use Mobile Health's health operating system for their own large-scale telehealth rollouts.
That would be a massive stamp of approval for their tech in the U.S. market, a very tough market to crack.
Absolutely. Then secondly, a lot of speculation around the formal closing of that Malaysian data center deal. If they close that and integrate the infrastructure smoothly in Q1, it removes a major execution risk.
And expands their growth capacity overnight.
Instantly. And of course, given their focus, we're hearing chatter about new business in the Asia-Pacific region. People are watching for a potential new corporate health contract.
Maybe with a big regional insurer.
That's the rumor. It would really grow their recurring user base. And finally, the one that always follows these kinds of stories.
Takeover interest.
Persistent rumors of strategic investment or a full takeover. A larger player looking to buy, not build, this kind of asset-light infrastructure would find them very, very attractive.
Okay, let's switch to the technicals. The stock chart has been showing some incredible strength lately.
It had a textbook bullish breakout. The price shot up over 56% in a single day. November 21st, closing at $4.75. That kind of move, it's a sign of renewed accumulation.
Of institutional money moving in.
You can see it in the indicators, too. The moving averages, both the 50-day and the 200-day, are confirming a clear uptrend.
Which, for those listening, is a technical confirmation that momentum is shifting into bull territory.
And crucially, the RSI, the Relative Strength Index, it's still in bull territory, but it's not overbought yet. That suggests there's still technical room for it to move up before it needs a pullback.
So what's a reasonable trading range to look at right now?
Assuming the news stays positive, it seems anchored between a support level around $4.50 and potential resistance up near $7 in the short term. Key support is really at that $4.50 mark.
It's interesting. You see some wild analyst targets out there, much, much higher.
You do, but we need to keep some perspective. Those huge numbers reflect the theoretical scalability potential, not the immediate reality. For us, the picture right now looks strong above $4.50.
So if you put this all together, what's the clear investment thesis?
The overall sentiment is it's overwhelmingly bullish. It's driven by that radical cost restructuring, the strong technicals, and that concentration of near-term catalysts we just walked through.
So for you, the investor, what's the best way to approach a stock like this?
Well, I think it's attractive for two different types of investors. First, the short-term trader who wants to play those catalysts, like the December and February earnings.
Right.
And second, it's compelling for the long-term investor who believes in the fundamental tailwinds for virtual care and the potential of this scalable global platform.
We have to balance that with the risk, though. What's the single biggest thing that could derail this whole story?
The primary risk, hands down, is execution.
Simple as that.
It is. They've done the hard part of exiting the old business and cutting costs. Now the really hard part starts. They have to successfully scale this new virtual platform globally fast enough to get back the revenue they lost.
So any slip-ups in integrating the data centers? Any regulatory delays in Ghana or Indonesia?
Or just slower than expected adoption. Any of that. And the execution risk becomes very real. They shed the weight to fly faster, but now they have to prove the new engine actually works at scale.
So that's the whole story then.
That's it. The restructuring was painful, sure, but it created an engine built purely for efficiency and scalability.
And the key for investors is to watch those upcoming Q1 and Q3 earnings reports. That's where we'll see if the new model is translating these exciting partnerships into actual sustainable earnings growth. That's the inflection point.
Agreed. The narrative is powerful, but the numbers in December and February have to confirm it.
It's a really insightful breakdown. Thank you for walking us through all that. And thank you, our listener, for joining us. We remind you to subscribe and join us for the next discussion on Smart Wealth with Joshua.